Hamish Rutherford Last updated 1404, October 9, 2017. The latest high comes amid warnings that the recent surge in shares may be coming to an end. New Zealand's benchmark Nzx-50 has hit 8,000 points for the first time ever, continuing a remarkable run for the New Zealand share market. A measure of the value of a group of New Zealand's 50 largest companies which have publicly traded shares, the record high reflects rising share prices and dividend payments. The index reached the psychological high for the first time just after midday on Monday. Shares in New Zealand have been surging higher since early 2009, when the index fell as low as 2,522, at a time when the economy was in recession and world financial markets were in turmoil. Over the past 5 years, the Nzx-50 has been rising between 9 and 24%, a period during which term deposits have typically been paying less than 4%. Read more. NZX lifts profit but market remains subdued. Grant Davies, an investment advisor at Hamilton Hinden Green, said markets had been buoyed by historically low interest rates, forcing investors to seek out higher returns on offer from shares, typically those with a strong dividend. It's just a story of companies that are performing reasonably well against a backdrop of very low interest rates, forcing people to take slightly more risk for the yield that's on offer. Currently, Meridian Energy, Genesis Energy, the majority Crown-owned electricity generators are paying gross dividend yields of more than 8%, far higher than returns in bank accounts. The Nzx-50 is a gross index, which means the rise takes account of the dividends on the shares, in contrast to well-known global markets such as New York's S&P 500 or London's FTSE 100. New Zealand's major listed companies are, compared to offshore indexes, more focused towards paying dividends. Davies said once dividend payments were accounted for, the New Zealand market had not enjoyed the same rise as had been seen on Wall Street. If you stripped out all the dividends that have been paid, we're reaching new highs, sure, but certainly not highs relative to what you've seen in the United States since the global financial crisis. The latest high comes amid warnings that the recent surge in shares may be coming to an end. JB were warned before the election that clients should slash their exposure to New Zealand shares by a quarter, while Forsyth Barr is also advising clients to consider swapping investments in New Zealand to offshore. Bernard Doyle, strategist at JB were, said in early August that New Zealand was one of the most expensive share markets in the world. The market has since risen by around another 3%, and Doyle said he had concerns about current valuations given the economy was hitting constraints. When you look at our economy, it's very hard to accelerate from this point. It would be a lot easier for it to go through a period of treading water or slowing down a bit, Doyle said. While JB was not telling, it's been just a lovely market to own for 5 years in an economy at full capacity and therefore more likely to slow than accelerate. Doyle did not, however, believe the market was shaping for a crash. I don't think we're in a bubble here. We're still telling clients to hold New Zealand shares, we're just saying hold a little less than normal stuff.